My name is Dominic Chaffee, and I'm going to be your guide through the first 100 days of your startup. Today is our third presentation in our 5-part series, and we're going to be talking about securities compliance. Basically, the fundamental question we're looking to answer is how can startup entrepreneurs raise informal capital without breaking the law? So I understand that securities law is somewhat of a dry topic, so I've tried to reduce hundreds of pages of securities law down to something that's easily digestible and only stuff that is pertinent to the startup entrepreneur. So, in our conversation about securities law, the first thing we need to know is what is a security. And in order to do so, I have a story that I'm going to help illustrate. So there was a guy named Howie, and Howie bought a citrus grove down in Florida. Howie wanted to expand his operations, so what he decided to do, he's going to sell half of his citrus grove in order to finance his operations. So he brought a bunch of business people down to his citrus grove, and he had a resort on his citrus grove, and he'd have them out on the resort, and he'd bring them out on the balcony, and he'd say, I'm looking to sell X amount of acres of my citrus grove at a uniform price. Whatever profits I make from the citrus that I grow on this grove will be distributed to you according to your pro rata interest in the grove. The business guy says, that sounds good. Sounds like a pretty good deal, but I'm a businessman. I know nothing about agriculture. Howie says, that's okay. I got you covered. I have this service contract, and I'll take care of the grove. I'll take care of the citrus on your grove for you. You have nothing to worry about. I'll pick it. I'll harvest everything, maintain the land. You don't have to do anything. Thing is, you can't come onto the land. You have no right to enter onto the land. You have no right to enter, and you have no right to take the citrus yourself. Business guy says, that's okay. I had no intention of doing that anyway. Well, the SEC gets wind of the scheme, and they're a little bit skeptical. So they decide to investigate, and they end up suing Howie in court. And so what happens is, this was a very early case, and the court had to actually determine what is a security. And this is what the definition they came up with. A security is a contract, transaction, or a scheme whereby a person, 1, invests money, 2, in a common enterprise, 3, is led to expect profits, and 4, the profits come solely from the efforts of a promoter or a third party. So let's apply that to Howie's case. Clearly, there was an investment of money. They paid a uniform price per acre of land in the citrus grove. 2 is, was there a common enterprise? That's a tricky one. We'll come back to that later. 3, were they led to expect profits? Of course they were. They were going to get the profits from whatever citrus was grown on the acre of land. 4, was it solely from the efforts of a promoter or third party? Yes, it was, because they had the service contract, which said, you can't even come onto the land. I'm going to take care of the maintenance and everything for this property. But let's go back to the common enterprise. Was it a common enterprise? They were buying a piece of land, right? It's just a piece of real estate. On each certificate it said, you own lot 3, you own lot 4, maybe you own a lot 6, 7, and 8. However, the way the profits were distributed from this land, it was not distributed in a way where if lot 5 made more profit from their citrus than lot 6, lot 5 did not get more money from that profits. It was distributed according to the acreage that they owned. Therefore, the court determined that you're getting your pro rata share of a common enterprise. Therefore, it fit every single element of the definition of what is a security, and Howie was guilty of, he wasn't guilty, he was not a criminal, but he was offering securities for sale without registering those securities, so he was sanctioned for that. So we talked about a court definition of a security, but let's just talk about it in practical terms, what's a security and what's not. So what is a security? A commodity is a security. When you buy a piece of gold on a commodities exchange, you're not buying the right to possess a piece of gold like you are with buying a gold necklace or a ring. What you're doing is you're buying a contract that places a bet that says, I bet that the future price of gold will rise. and then it may or may not. A variable annuity, that's a debt security. Interest in a partnership is an equity security. Interest in a limited liability company, also an equity security. Stock, that is that's an equity interest in a corporation. And a note is a debt instrument wherein if you're trying to gain financing for a company, you can get a note. It's like a loan essentially, and the creditor makes some money off of the interest that goes from the debtor to the creditor on that loan. Say it would be 6% over a certain period of time, payable quarterly or something like that. What is not a security? A franchise is not a security. If I want to start a McDonald's franchise, it has been argued that they have a security interest in McDonald's, but that's determined by the court. That's not a security interest, among other things, because obviously when you purchase a franchise from McDonald's, you have managerial control. You have practical control over how much profit that franchise makes. Next, pyramid schemes. Pyramid scheme is a fraudulent activity. That's not a security at all. Pension plans. This might seem like a security to some people. You know, you get a paycheck, and maybe a certain percentage of your paycheck comes out every month or every paycheck and goes towards a pool of money that you get later after a retirement or something like that. It could be seen why people would think that's a security interest, but it's actually not. And why is that? Because you're not promised any expectation of profiting off of your pension plan. Next, real estate. Real estate is generally not a security, but as we saw in Howie, when you're combining the property with the management of that property, it then can become a security in those instances. Okay, so stock market crashes in 1929, and the government, they get together and they decide, all right, we need to put some regulations in place to make sure that people are protected from something like this happening again. So they come up with the Securities Act of 1933, and among the provisions of the Securities Act of 1933 is that it is unlawful to offer a security for sale unless a registration statement has been filed. So we have three things there. What is an offer? What is a security? And what is a registration statement? An offer is any activity reasonably calculated to generate a buying interest or solicit a buying interest. Security, we already talked about what that is. But what the hell is a registration statement? A registration statement is also known as an S-1 form. It's filed with the SEC if you want to offer your securities to the public for sale. A registration statement, essentially what you're doing is providing disclosures to investors so the investor can make a calculated, informed investment decision about whether they want to invest in your securities or not. So things that they have to disclose would be, first of all, what type of securities are you offering, obviously? What exactly are you using the proceeds of the finances for the security would be another thing. Who is the management team behind this company? And what do they do? What is their education? What is their experience? What are the risks of this business? What are the risks that this company could fail? So there's a lot of things that has to be disclosed. It's quite a complicated document, as you can imagine. Oh, and the business plan, that's what I wanted to say. What is your business in the first place? That's pretty obvious. Okay, so it sounds like a pretty complicated document, and it is. If you look up Facebook's recent registration statement that they filed, it's 198 pages long. In fact, the SEC themselves estimate that the average time burden to fill out a registration statement is over 972 hours. That is a lot of time, resources, and money that startup companies do not have access to. So what can startup companies do to raise informal risk capital? Well, there are actually exceptions to the rule that you have to file a registration statement, so I'm going to talk about a couple of those. The first of these exceptions is Regulation A. Under Regulation A, you can offer up to $5 million in securities in any 12-month period. Now, the caveat to that is that you have to file an offering statement, which has also been deemed a mini registration, meaning that while it is not quite the complexity of a registration statement, it still is quite a burden on a startup company. You're still going to have a lot of those same type of disclosures. Easily could be over a 50-page document. One thing you can do with a Regulation A Regulation A offering, though, is you can test the waters, which means you can solicit investment in your security before you file your offering statement. When you test the waters, you're soliciting investment in your offering statement, not actually getting the people to buy it, but just you're measuring the interest in your offering, essentially, to see if you should even do it or not. With Regulation A, you can publicly solicit your securities to both accredited and non-accredited investors. I'll talk about accredited and the difference between those two later. And finally, your securities are unrestricted, which means in the case of a restricted security, the initial purchaser of the security cannot offer that, then go again and offer that security to somebody else on a secondary market or to anybody. An unrestricted security, they can't offer that security. The initial purchaser of the security can later then offer it for sale if he doesn't feel like it's a good investment anymore or for whatever reason. Regulation A, as I said, the offering statement still makes it pretty cumbersome for a startup company to do. That's still a lot of man hours, a lot of time that that the startup company does not necessarily have. It's cumbersome. So what most startups do is they try to do an offering under Regulation D safe harbors. In Regulation D safe harbors, you file a Form D with the SEC, which is an online form that can be filled out, and it is much less requirements of disclosure, much more limited disclosures that you're required to provide. There's three main different types of Regulation D offerings: 504, 505, and 506. I'm going to go through some of the attributes of each of those right now. So 504, you got a $50 filing fee. That's not too bad. But you can only raise up to $1 million of securities over a 12-month period. These securities are going to be restricted securities, which means the initial purchaser of the security cannot then go sell it again. Sometimes there's time restrictions on that, but let's stay out of that realm for now. There's some limited disclosure requirements that have to be done. Mostly, you're still going to be you're subject to state disclosure requirements, and I can't necessarily go into those because those are 50 different types of requirements at this point. Rule 504, in most Regulation D offerings, there could be no public solicitation of your securities, but 504 does give you an exception. General solicitation of your securities is okay as long as you're only soliciting to accredited investors and you distribute your state-required disclosure documents to those accredited investors. I'll talk about what is an accredited investor right now. An accredited investor, there is a delineated list. There's a delineated list of what is an accredited investor. So we have a bank would be an accredited investor, an insurance company, a professionally managed employee benefits plan, a charitable organization or company that has over $5 million in assets, the director or executive of the company selling the securities is actually considered, no matter what, an accredited investor. And finally, a person with a net worth of over $1 million will be considered an accredited investor as well. 505, $300 filing fee. Up to $5 million you can raise over a 12-month period in securities. You can have unlimited amount of accredited investors and up to 35 non-accredited investors. Your securities in this situation are going to be restricted. They can't be resold. You do have to provide audited financial statements, however, and you're going to have to provide advanced disclosures to non-accredited investors. With non-accredited investors, you're going to have to make disclosures that are more along the lines of the Regulation A security filings. With accredited investors, much less stringent requirements are required for them. And like most Regulation D offerings, they must be private. There can be no general advertising that you're offering your securities or general solicitation to the public. 506, very similar, but a couple of important caveats. 506, once again, $300 filing fee. In this case, we have an unlimited offering amount, unlimited accredited investors, and up to 35 non-accredited investors. But in this case, the non-accredited investor must also be a sophisticated investor. A sophisticated investor, as defined by the SEC, is someone that has the requisite expertise and knowledge that, I'm trying to remember the definition, requisite expertise and knowledge to understand the risk of investment. That's actually a higher threshold than you might imagine. It can cause some problems. But what people can do to alleviate those problems is if you hire a professional, somebody who would be unsophisticated, can hire an attorney or an accountant to give them that requisite expertise and experience in order to make them classified as sophisticated. Once again, the securities are restricted in this case. You're going to have to provide audited financial statements. And also in this case, a 506, this is 506B, a seller must be available to answer questions from investors. So recently, they passed the Jobs Act, and this added 506C to the types of investments that you can do. 506, the original 506 remains in place as 506B, but certain changes that were made as 506C, which eliminates the 506 prohibition against general solicitation and advertisement. However, all purchasers of the securities must be accredited investors, and the issuer has to take reasonable steps to verify that the purchasers of securities are accredited investors. What does that mean? We don't really know yet because it hasn't been litigated, but what we can assume is that the more evidence there is that this person is an accredited investor, the less steps that you're going to have to take to verify that this person is an accredited investor. The other thing that it does is it allows online matchmaking platforms for 506 offerings. They don't have to register as a broker-dealer anymore as long as they're not compensated, which means as long as they don't get a management fee for providing this online platform that has these offerings on the platform. And that's where I did come in with my plug. The iSelect Fund, I wouldn't be here if I wasn't plugging something right. One of these things being the iSelect Fund. And what the iSelect Fund is, it's one of these online platforms that brings together venture investors with startup entrepreneurs. And what we're trying to do is create a platform where if we can increase the deal flow between investors and entrepreneurs, then we can create a situation that is favorable to both of them. And okay, so what happens is a company applies to the iSelect Fund, and they go through 3 tiers of diligence processes. They are vetted by, first, just an application process. Does this person meet the requirements of a 506C investment offering? Next, they're going to be vetted by a team, a selection committee of experienced entrepreneurs and angel investors that are very well renowned in the St. Louis area. They're going to evaluate each company on a series of metrics, asking a certain amount of questions about their management team, the viability of their product, so on and so forth, in order to determine if this is, first of all, should it be on the platform, and second of all, how does it rate as well with the other companies on the platform. So once on the platform, each company gets a diligence profile. And the diligence profile will be made up of much of the things. If you look on your handouts, there is a diligence checklist that we ask for from each company. And the diligence profile will provide all those informations to potential investors. So they can look at each company, and what the iSelect fund allows somebody to do that other angel investment funds don't necessarily allow people to do is to spread their investment like a mutual fund, and have like a portfolio. Choosing, say there's 20 companies on the menu, you can have 5 or more companies in your portfolio for maybe a $50,000 minimum investment. Say you want to have $10,000 here in this company, $10,000 here, $10,000 here. Most platforms do not allow you to do that. The iSelect fund does. It allows the investor to mitigate that risk of investment while also being able to realize the outsized gains that are available from the startup market. Oh, and of course, they're going to have to provide the companies, once an investment is made, that's okay. Once an investment is made, post-investment, these companies are required to provide additional disclosures to keep the investors updated, additional financial statements, so they can monitor the progress of their investments. So maybe some of you guys came here to hear about crowdfunding. I'm sorry I haven't talked about it too much yet, but I'll talk about it a little bit now. The reason I haven't talked about it too much is because Title III of the Jobs Act, which mostly addresses crowdfunding, has not yet been instituted. There's been proposed rules by the SEC, but they're not yet available for the public use. So what some of these proposed rules are? Oh, for those who don't know what crowdfunding is, it's essentially soliciting investment from a large number of parties at a smaller dollar amount. That's essentially what it is. So in the proposed crowdfunding rules, no more than $1 million of your offering. The offering, however, must be conducted through a broker-dealer or crowdfunding portal. We've all seen the crowdfunding portals. Fundraiser? Kickstarter, Indiegogo, Rocket Hub is another one. There can be no public, this is an interesting caveat to this. There can be no public solicitation for these securities. But what can be published is the crowdfunding portal can advertise their crowdfunding portal, and within that advertisement, they can provide notice to the public that there are certain one or more companies on their platform. So it's kind of a roundabout way of advertisement to a degree. Now, part of the reason why these have not been instituted yet is because there's more limited disclosure requirements from the Crowdfunding Act. They're trying to entice investors, or they're trying to entice more investment to get people involved. So they're having more limited requirements from people to do crowdfunding. But that scares some people. That scares the SEC, because they're there to protect the public from making an uninformed investment and from being defrauded by a scam or some type of a scheme. So one of the things that the SEC proposed was we'll have, in order to offset the risk of people, losing a lot of their losing like their whole bank account or something like that, we'll put certain caps on what they're able to invest. So under the crowdfunding rules, the maximum securities that can be issued to one investor are different for if an investor has a salary of less than $100,000 or over $100,000. If less, you can invest the greater of $2,000 or 5% of your annual income. If more than $100,000, you can invest up to 10% of your annual income in the company. So crowdfunding today, okay, it was Fundable. That's the company I was thinking of. Fundable, Kickstarter, Rocket Hub, Indiegogo, all viable platforms for crowdfunding, although the only one that is actually selling equity, actual securities, is Fundable. And at this point, they've only been raising mostly between $5,000 and $25,000, although I have seen up to about $300,000 people have raised on Fundable before. Kickstarter has publicly come out and say that they're not going to offer equity securities. They are going to stick to the rewards programs that they have. Rocket Hub and Indiegogo are also going to they're sticking to the rewards for now, but they're contemplating possible offerings of equity in the future. Now, when we think of crowdfunding, most people do Kickstarter comes up, Indiegogo, maybe Rocket Hub, although I haven't really heard of that before. That's what we think about as crowdfunding, but it's really not. It's not what was contemplated by the SEC when they came up with the Jobs Act crowdfunding. You're not offering securities. They don't. So what Kickstarter and Indiegogo is more akin to is a donation. It's like when PBS tries to raise money and you get a tier. At the $35 tier, you get a handbag with, the PBS logo or something like that. And then, you raise $10,000 and then you can get maybe dinner with the CEO or something more prestigious, I guess. So none of those are securities. So don't get it confused. Crowdfunding with equity, crowdfunding with rewards. Okay, so what can we do to prepare our startups for crowdfunding or for any type of funding investment? The first thing you need to do is corporate cleanup. If you're incorporated or organized, that's great. If you're not, get incorporated or organized. If you are, we talked about this before, you need to get your corporate house in order. You need to have your bylaws if you're a corporation, your operating agreement if you're an LLC. You need to have, let's see, articles of incorporation, bylaws. You need to have your corporate minutes in order. Make sure your corporate minutes. This is interesting. It's amazing how many times I've seen already in my young career as an attorney that the annual reports, the board of directors on the annual reports does not match up with the board of directors that is in the articles of incorporation or the amendments of the articles of incorporation. And at that point, any minutes that were signed or any resolutions signed by the wrong board of directors they're void. They don't work. So you have to go, if you don't realize that was a mistake, you're going to have to, that could cause definite problems in your offering, your resolution. Because your resolution to get funding or offer securities would be invalid. So it's important to look through this, make sure you have everything together. If you did miss something back in the day, but with your board of directors, it's easily correctable as long as you make sure that you go back and check it out. Next, okay, fundraising terms is something you're, obviously, what type of terms, what type of securities are we going to offer? Are we going to offer debt? What interest rate are we going to offer debt at? How much? Are we going to offer equity? If we're going to offer equity, we have to determine what is the valuation of our business and what percentage of our business are we going to give away for what amount of money. Obviously, we want to have a business plan. Actually, the business plan has fallen out of favor, but I'm a proponent of the business plan because maybe if it's not even for the investor, but it's for yourself to a degree, that you have a clear-cut. An investor wants to see this too. Does this person have a clear-cut idea of what they're doing? Do they have their manifesto laid out, what they want to do and how they're going to do it? So from the business plan, from that point, it begets the executive summary, which is just a summarized, surprised version of the business plan. And a pitch deck can also come out of that, which is more of a stylized presentation version of your business plan as well. Then you're going to want to have your financials together. You're going to need cash flow statements, the most recent balance sheet that you can come up with, profit and loss or income statements. And in some cases, maybe, okay, if you're a startup, maybe you don't have very much history of financial history, maybe it's not really worth very much to an investor. Well, you get what you can, and then you come up with pro forma financials for that investor. And of course, these are estimates of what the future of your financial status looks like. That's okay. That's not a bad thing. But what you need to do is, obviously, when you're making estimates about what it's going to look like, but you have to make sure that your estimates are grounded with evidence, or else you lose all your credibility with your investor. So don't go crazy thinking, you have a way bigger market than you do, or something like that. Closing documents. That's like your subscription agreement. That's something that's pretty much what the final thing that somebody's going to sign in order to purchase your securities. They sign on the dotted line. And if you're in the case of an organization, or an LLC, they're also going to have to agree to the terms of your operating agreement as well. Which the subscription agreement will serve as a proxy for that. Oh, and so that's another thing you guys can look at on the handouts that I have. There's a series of questions on there. Those are the type of questions that you need to start asking about your own business, things that you need to contemplate in order to determine if you're ready to have funding. Another thing is the diligence checklist. Make sure you guys have that stuff all together. Maybe you won't need to be as we go above and if our law firm goes above and beyond with our disclosure requirements. Why? Because that's what investors want to see. They want to know that they're investing large amounts of money. Some people 50 grand at a time is not unheard of, and they want to know that this person has all their ish together. What else do I have over there with you guys? Oh, and then I also have a handout with the services that we offer to help private placements get together. We offer business plan writing, and we also will get the diligence together. We put together a package that presents to investors in a professional way. Okay, well that's my presentation. I want to thank you guys for coming. The next one is going to be April 30th. It's always the last Wednesday of the month. Our next one is startup financing, structuring and negotiating the best deal terms, milestone strategies and valuations. So that's a lot of the stuff that's going to be on your term sheet and how we negotiate those type of items. If you didn't feel like you get your money's worth, once again, have more beer, maybe you will. And thanks again for coming. Appreciate it. And I'll open up for questions.